want to bring in Ian Franco Francis, manager of CQS New City High Yield. Obviously, Franco is a very well-known sort of name in the space. But just to give you a bit of a background of who he is and where he is at for anybody who's not familiar with him. He's sort of Chief Investment Officer for New City Investment Managers, which is part of Manulife CQS. And he has day-to-day responsibility for managing CQS New City High Yield's portfolio. Ian has well over 40 years investment experience, primarily in fixed interest and convertible sort of space. He's worked for sort of Colin Stewart, West Dalby, Panmure, James Capel, and Horgavet. And basically, he joined New City Investment Manager in 2007 to manage this fund. So he's been doing it for a long time and has sort of made a very decent fist of doing so. So, Mr. Francis, are you there, sir?
All right, good morning.
So just for anybody who's perhaps not familiar with the fund or could do with a sort of bit of a refresher, can you just, perhaps give us your 10, 15 minutes, just give us a sort of extended elevator pitch. Tell us sort of what you do and how you do it and how the fund works, really.
Right. Well, obviously, trying to go through the deck we've given you, I think we can skip number 2, which is the sort of pitch on CQS and Manulife. Manulife took us over in April, and at the moment they bought us as specialist credit house, and we will gradually be working much closer with our Manulife people. That they have very little in the UK and Europe. They are mostly US, Canada, and the Far East. So there's no great overlap. They own John Hancock, which is obviously very, very large in funds in the States, but not closed-ended. So the New City element is quite unique. So there will be very little change there. And the fund itself, more importantly, listed in London, but Jersey domiciled. So the great advantage is you don't pay stamp duty when you buy the shares, which, the less tax we have to pay, the better our performance is for all of our own personal accounts. The target is to provide a high dividend yield, currently at 8.62. And we invest in basically high yielding fixed interest securities, both small and large, more niche because we can get better yields in niche businesses, smaller issues where companies can't afford to go and get a Moody's credit rating. We have a lot of analysts internally that can look very, very deeply at stocks. So don't let it worry you, the fact that we haven't got investment grade paper, because if you had investment grade paper, you wouldn't be getting 8.6, you'd be getting about 4 on a good day. Go back to slide number 4. Right, this is the year to June 24. What was a good year? Obviously, total NAV return of 19.07, ordinary share price return of 22.73, and yielding 8.62. Ordinary share price premium 5.26 so that June. That is sort of, we try to keep that as the norm, because obviously the line below you see we issued just under 13.5 million pounds worth of new shares. We won't issue on a premium of less than 5 because all of us who are investors and all of those future investors, we want to be on the same basis. We would not be very popular if you're trading on a 5.5 premium and then we issued a whole load of shares on a 1 premium. because effectively you would reset the norm of the premium to 1% without even trying.
Does it in
Why
any
do
way
we
relate
issue
to the issuance costs, or
that high sort of premium? Well, first of all, you have to pay the broker. Then, NAV is always calculated off the bid of the market. And if you're investing at the offer, so you have to certainly more than cover the spread, and then you actually benefit existing shareholders for a little bit of capital every time you issue. And
so there is some
obviously, as you're
logic
issuing more
to that
shares, you're
5%
slightly
target.
diluting the reserves that we have built up over the years, and you continue to try to do so. So you have to make sure that everybody is on a fair and equitable basis. Old-fashioned, I know, but that's me, I'm afraid. Right. Obviously, the dividends on the next slide, 5, please. We've got a long-term increase in dividends, albeit very, very small per year, but it's a nice thing to do. This year we 100% covered the dividend with our earnings, which is ideal. In a perfect world, we'd add to the reserves, but you see there that the revenue reserve is 2.93p per share. Now that's very important because worst case scenario, you get a default, or you've got the equity element of the fund maybe having a dividend that comes after the year end. It allows you to smooth out the income stream, because we all like our dividend 4 times a year. Thank you. But the most important element is that when you get shocks, like we had in 2008-9, like we had with COVID, then you are able to continue to pay the income. It would have to be almost Armageddon to use up all of that reserves per share in a short period of time. So for those of you that, like myself, that like to see the income, that is a very important feature. Page 6, please, Matt. This is just sort of one of those things that sort of shows total returns. If you'd been in one of our competitors, Invesco, Bond Income Plus, the all share, and our total return is above all of those, obviously, because we are looking after the capital. And when you reinvest income, compound interest is a wonderful thing. Always best to be on the receiving end of compound interest, not the paying end. Absolutely. Number 7, please. Right, this is very important to all of you. The investment process is fairly simple. You can, the more simple you make these things, the less they go wrong. I'm obviously running the portfolio day to day. I'm constantly looking at all of the share prices, all of the bond prices. I do keep an underlying view on equity prices, where they exist, where we hold bonds, because it also gives you another input. I have plenty of corporate analysts on credit, to look at stuff on a daily basis, and that they will come to me if they see something that is relevant to what we hold or what we should hold, or possibly something that we've got and we shouldn't hold. It's the research is definitely two-way. I will be monitoring, looking for new opportunities. They are doing the same. They come to me on a regular basis particularly our financials analysts, because obviously we're, a large percentage of the portfolio is in financials, and therefore you work very closely with these people. We also get very good research, not necessarily from the bulge bracket, because they're more corporate led, but more of the boutique brokers who are looking for ideas to make money for their investors, and that works particularly well. So as you go across, we obviously got all the fundamental research. The actual portfolio construction is not as complex as it looks there, because if you've got a sector in the market where you can only get a 4 or 5% yield, then we can't have exposure to it.
Yeah.
I go back to financials. We've got good yields there still, so therefore we have a large exposure. But in areas where it is not possible to get exposure because of the low yield, they just don't appear, because you can't afford to have any exposure that is actually costing you money. And this is a 365-day a year and 24/7 process, because we all are connected on Bloomberg and are obviously in internal emails. So even when you're on holiday or they're on holiday, we have access to their thoughts, because that's the way the business is these days. Number 8, please. Right, this shows you how we are currently balanced with the spread. You'll see obviously the financials right at the top, not quite as much as June 23, but I think you'll probably find that currently now we are going to be probably much nearer that June 23 figure for financials. Energy is obviously less, because obviously you have to be very aware of global warming, ESG, and all the rest of it. But energy is also includes biomass in some of our bonds.
Right.
So it is green energy. Unfortunately, energy also covers green and not so green. Industrials it is certainly back up to the same sort of levels. I think you'll probably find that more was due to a bond getting called in June 23, so the exposure came out, and it actually went back into the sector actually in July 23, so it was a bit of a odd figure. But the rest we don't particularly have big opportunities. I mean, consumer discretionary is mostly the hotel sector in things like Travelodge, Stonegate, the managed inns business. They are making up the majority of the consumer discretionary, and the rest are much smaller figures. Next page, please, Matt. Yeah, I mean, this is sort of self-explanatory. We are mostly fixed income. Obviously, we do have. It shows 14% convertible to equities and preference. Now, obviously, preference shares by their nature are effectively debt, but for this benefit, they come in, and we've got about 4% in preference shares. So if you took them out of the sort of the equity content, it'd be nearer 10. But so number 10, please. Right, I can talk you through The top holdings we have in this portfolio. Co-op obviously is now owned by Coventry Building Society. We have been very long-term holders of Co-op Bank. We were in the existing Tier 2 bond when it was trading in the low 90s, and which it was refinanced in 2023. So the markets were still not in a great place post the Trust Kwarteng debacle in 22. So we were able to get a very good coupon of 11.75 on that, and which was excellent. But even better, the fact that Coventry Building Society wished to buy it soon thereafter, and we now have a bond that we were obviously issued at par, is now trading up at about 120. So still got a very good running yield to it, but being that far over par, at some stage, if there are opportunities elsewhere within financials, I will be looking to switch across. Below it, Galaxy Finco, that is domestic in general, which is effectively long-term holding. We've held that again. That's another one we've held excess of 7 or 8 years, and a refinance there as well. But the actual company provides warranty and servicing on boilers, white goods, and consumer electronics, and is doing exceedingly well. Next one up, Virgin Money. Very similar story to Co-op, except for this time we had another building society nationwide come in, and we've had excellent performance out of that, and still getting a good yield. Aggregated Micro Power is our biomass business. It has been sort of we've had this since 2016, and added to it on the odd opportunity, because it's a very well-run business. Very very boring business, but which is good in my opinion. Next down, Travelodge. Obviously, this is yet another one of the consumer based, and with a 10.25 coupon. We bought this very close to issue, and again, it is doing a job. Thank you very much. Nothing really to write home about. It does what it says on the tin. RL Finance is Royal London Mutual Insurance. Very well run business. Again, when it was issued, we were still in the sort of tail end of market turmoil in the UK. So again, we're very, very happy with that. And also performing well. REA is palm oil, which a lot of people jump up and down about it. This is spot registration, is sustainable palm oil, and it by and large provides palm oil to the home market of Indonesia. It's very well managed, very old, very boring, but again, they just keep doing what they say on the tin. If you look at the moment, palm oil price is very strong because palm oil yields are a bit down, but actually that helps companies like this because the margins are greater. So happy with that. Stonegate Pubs, obviously that refinanced earlier this year, and we've got actually a better coupon than that now, because this top 10 was taken as at the June figure, and the coupon now on Stonegate is hang on, that one is, apologies, I'm just everything written off the yes, this 10 3/4 coupon. So it's
Oh wow.
we certainly benefited from that one as on rollover of finance.
Why did
This has
that get
happened
such an uplift?
a few
That's quite
times. The
generous.
Co-op Bank, Shawbrook, when that turned did the same sort of thing, and now Stonegate. So finally, Inspired Entertainment, online games producer, provider of content to many businesses. Again, 7 7/8 coupon is trading below par, so it's giving us a yield very, very close to 8. In normality, because we actually use a bit of gearing, currently about 12%, we can, at the end of the day, invest in something that's yielding just below 8%, because by the time you put the gearing on, you're getting a yield of over 8. Next page, please. Well, that's just historic. Shows where the premium was, and say apart from a couple of weeks in 2020 when the world decided that COVID was going to be the end of the world very shortly. We have, by and large, mostly traded at a sensible premium, as mentioned earlier. And I think sector themes I've already covered anyway, which is on page 12. This is just so does what I've been saying is how we operate, and really open to questions.
Cool. Okay, we've certainly got some coming in. I suppose just one thing I think probably would be useful to just have a sort of quick look at. Obviously, seismic shift in the US this week with sort of Trump's election. I mean, what's that doing to credit markets?
Well, initially, US Treasuries didn't like it. No great surprise there. Obviously, the US dollar did. We know he's going to sort of slash taxes and what was it, drill baby drill or something, I think was one of his other wonderful phrases. I think you have to almost take Trump day by day, because I currently don't have an X account for the former Twitter. I just have a feeling that if it's anything like the last time he was in, we all need to have our X accounts and follow Donald Trump to see what's going to be moving markets, because anything that he comes out with is going to move markets. But yeah, I mean, the trade wars are obviously going to be a very interesting point. I mean, last time he was having a trade war with China, that they ended up doing a nice deal where the US is shipping an awful lot of oil to China. The fact that China is probably getting a nice lot of Russian oil at the moment might make things different there. For Europe, which is obviously where we don't invest much in the US, so that doesn't bother us too much, the volatility over there, just the knock-on effect elsewhere. Europe is going to have a hard time. It is all the powerhouse in Germany is already being hit hard with its auto sector being almost blitzed by the cheap Chinese EVs, which I'm informed by my nephew that drives one in Dubai. They are every bit as good as their German equivalents as regards reliability. Well, yeah, okay, but I think this is the problem. We have got, it's going to be bad for Europe. European politics is sort of going to the right. It is not looking good really for the European economy. That they do need to sort of get things better, which brings me on to the UK, where we saw the Bank of England cut. Well, I mean, that was effectively baked in anyway. But post that budget, I think we are going to see inflation be much stickier, and it is definitely a case of higher for longer. And whether or not they actually manage to get the economy growing, it certainly is not going to grow in the private sector with all of the various tax or national insurance and lower rate sort of earnings being pushed up to a much higher level, which I think is costing somebody like Marks and Sparks something like 120 million, I believe, and I think it was going to cost Tim Martin's pub business something in the region of 140 million. So all of this is going to be passed on to the consumer one way or another, and that's going to be there for some time, because if you're not growing your private sector, you're not growing GDP other than in the public sector, which is another matter.
Yeah, I suppose sort of related to that, I mean, how does all of this work? How does this sort of fund work in a falling interest rate environment? Does that make it presumably more challenging to get the yields? And what do you do about that?
Well, I think higher inflation environment yields will stay higher for longer, because of all of the costs in the private sector. It's going to make, if you like, their whole balance sheets more stretched than they would have been. So I think you're going to see higher rates for investors now for a while. Okay, you've seen gilts come down a bit, but I think as all of this actually beds in more, I think the forecast growth in the economy from the OBR is a bit too bullish. I personally cannot see this. I've talked to many small businesses, people with care homes, people with sort of small. I won't talk about my farming friends. They're apoplectic, but a lot of small businesses are exposed and are very worried that they will not be making any money or that for the next few years. So economy not great in the UK, which means we're still going to have opportunities with higher yields there for time to come. And when we do finally start to get lower yields coming in, then obviously the bonds that you have with a higher yield will perform in the capital front.
Okay. Now, sort of got one question here, just quite interesting, because I wasn't aware. Somebody said, what was behind the decision to invest in Aston Martin?
Right. The very simple answer to that is we've done a lot of internal research on that one, and it's like we have done in some other companies before. You have a company where you have a backer that has an exceedingly large cash pile, and these are it's premium stuff. It's not going to be affected by Chinese vehicles. It's top end. It's premium. It goes to the Middle East. I mean, I think half of the Vanquish sort of future production is already sort of booked into for the Middle East, and we see that surviving, and with Lawrence Stroll behind it. Obviously, you also got the ego point. He would not like to see anything he has do anything other than succeed.
That makes a lot of sense. Okay. Obviously, we're talking about how this sort of works in a sort of lower interest rate environment, etc. There is this thing, obviously, being very much focused on high yield, and so people need to get their sort of head around that. But what's the sort of historic default rate been like? Can you give us some sort of context on that?
Yeah, the default rate has not been horrendous. I mean, obviously, at the bottom end of the portfolio, there's a lot of positions which are companies that were there when I took it over, and they were there because people don't seem to wind them up. They seem to just sort of still be there and just sort of like a shell. But also, yes, we had Credit Suisse. We only had an exposure of about £1 million to Credit Suisse in that one, and we expect we'll be getting something back on that. Raven Property, we still think we can get some value out of that because it has now moved its domicile to Abu Dhabi. So there's a chance of getting something out of that. And Banco Popolare was obviously one where politics got involved again, rather than fundamentals. Those are sort of the major ones that we've had. There have been a few smaller ones, but if you size your risk accordingly, these do not damage the performance, which I suppose can be proved from the last 17 years.
Well, it sounds like you've only really had 3 events to concern yourself with in 17 years. Is that right? I mean, that.
Yeah, I mean, as I say, there are some smaller ones in there, but the thing is,
I just expected more from a high yield fund, so I think that's quite.
Yeah, it is. It's I say I'm right up there with investors. That, I mean, currently I've got about 657,000 shares in this, and it will be more when my dividend is paid in November, because it's in an ISA. So I am very motivated to make this perform.
I was going to ask about alignment. You've solved that for me. Just, I guess, in sort of terms of the sort of financials and banks, because there is a lot in there. So a lot of the allocation is sort of driven really by where you can get the sort of opportunities. Is there sort of anything else that really you would add that would sort of explain that why it's got a fairly chunky sort of exposure to the financials? There's sort of key things that you like about that.
Well, I mean, post the GFC, the UK financial sector really worked hard to get in a good place, and so with my very, very good financials analyst, we are monitoring them daily, and we keep clear of things like Vanquis, which hasn't really helped us, but there's not a lot out there that we could be in that we're not. So
you're quite selective.
The UK is a pretty strong place. Obviously Metro Bank is one that we've kept clear of. We're still not quite happy with it, but we don't need it because we are getting the yield elsewhere. It's not a case of we are hostage to, oh, it's a high yield, we've got to have it. There is plenty out there for us to invest in that we like, and can sleep at night with. I know I might have white hair, but at least I've still got it.
Did you have any close brothers or anything like that?
Close brothers is one that we kept very clear of at the issue, because of obviously we sort of saw what was coming. It will be one that at the right level, which is probably in the slightly below where they're marked in the market moment, which are about 93. If they get down to about 90, the risk reward there will look more sensible, and it's something we would probably put in there at that point.
Now, there's something we sort of talked about before. I know there was a period of time when sort of interest rates were getting much lower than they are today, where it sort of got tricky, trying to find the sort of bonds of the quality that sort of gave you the yield, etc. And obviously these things have a date to expiration, so you've got to continue to refill the hop. I mean, how are things on that front? Is it sort of quite a deep market? Are you seeing plenty of opportunities?
There's plenty out there, certainly in Europe, Scandinavia, and the UK currently. But don't forget, we also have the opportunity for equities. You have M&G and Phoenix Group, which we are in, and they're both giving you a 10% dividend yield, and they're both very, very safe dividends. And in the sort of say renewable space, we have obviously got an investment in Next Energy Solar, which we've sort of added to at these lower levels. We didn't. I don't think we've paid above about 77 for stock in that one. But we're getting a nice double-digit yield and a very large discount. So that gives us two sets of opportunities.
No, that is really interesting. Now, there was something we were sort of talking about earlier. You were saying, one of the bonds was trading up at sort of 120, and you would expect that to sort of, potentially be called. I mean, what tends to happen when these things get called? Do you tend to get some sort of premium out of that? Or?
No, it won't get called at 120. I mean, it's something that we will probably start to sell.
Oh, sorry, you're going to sell that? Sorry, yeah.
It will get redeemed at par. So if you like,
you want to get out of
sort
that.
of amortizing it down from 120 to 100 till the redemption date. But yes, I mean, when bonds get called, a lot of the time they're refinanced. This happened certainly with Stonegate was refinanced. The co-op tier 2 refinanced. It happens fairly regularly, and if you're, I mean, something that we were in that we sold relatively recently, Beauparan, that is now in the process of refinancing. But it is one that had a hard time, was trading down in the low 60s, and when it recovered to the mid to high 90s, we exited because we thought it could be difficult to refinance, but it looks like that they have refinanced now at a premium yield to that. It's something else we might look back into, but being cautious, we're coming into the winter period when the dear old bird flu rears its ugly head again, and you don't quite know what's coming from Europe on that front until sort of later this month, early December.
Right. Okay. I guess just talking about the exposure is something you sort of commented on earlier, how you can sort of amplify the gearing to take a bond that you like, but it's perhaps not got quite the yield and fight to get it to sort of where you need to be. But what really sort of drives the overall strategy for how much this is geared? And sort of how much does it vary?
Prudence.
Mm.
I mean, we could go to 25% gearing, and people sometimes encourage me to do so. I mean, the only time you really want to gear up is when the whole world look like it's sort of ending. But we use the gearing really to just, it helps pay for all of the fees and enhance the income, because obviously if you're gearing on something that's 8, that gives you higher. But if you're using the gearing on something that's say across the portfolio and it's yielding about 9.5, then it is just enhancing to the income, and providing you're correctly positioned, it helps the capital as well.
Okay, that makes sense. I mean, so I guess during difficult market events, let's say when spreads widen, capital values fall, is that kind of the time that ideally you would ramp up the gearing a bit? Is that
that's what you look to, so when everybody's jumping out the window, that's when you should be,
you want to be buying.
investing. By and large, it's over history that is very much the case. But yeah,
what's the kind of sort of natural level, do you reckon, for this typically?
Well, the natural level normally is between 10 to 14% gearing.
Right. Yeah.
I think if we end up in a situation where the markets were really having a bad time, I think you might take it to about 18. I don't think you'd get anywhere near the 25.
Yeah.
I mean, this is to provide income for investors, allow them to sleep at night, and not have to worry about highly geared portfolios.
Okay, cool. That makes a lot of sense. I am just kind of conscious of the time. So one question here. Just can you sort of talk about the duration of the portfolio and sort of where you like to have that?
Yeah, the duration historically and currently is around about 3 years. I mean, a lot of the time when high yield issues come out, they are sort of 4 to 5 year duration. Some of the stuff in Scandinavia is 3, but obviously some of this stuff might be a 5 year duration, but it can be called after 3. So we don't have, yes, we do have some perpetuals in there, but again, if I've got a perpetual bond in there, I don't like it to be too far over par, because duration is not your friend when you're trading, say in the 120s, 130s, and rates move. You can write off quite a bit of capital without trying.
Yeah, that makes a lot of sense. Right, I'm conscious we're coming about 12:05. We started about 5 minutes late because of our sort of technical issues. So apologies once again, everybody, for that. I just kind of, before we wrap up, I guess sort of why this fund and why now?
Well, why this fund? It pays you, a very comfortable 8.6 income stream. If it's in your ISA or SIP, the benefit of compound interest is great. The manager himself is invested in it and continues to invest, and it's a long-term game. It's this is not a get rich quick scheme. This is what they get rich slowly on the back of compound interest. And with the reserves that are in place there, that dividend to me is certainly safe for a long while yet. And through whatever market conditions prevail.
Brilliant. Okay, well, look, thanks for that. It's been really interesting. You had a sort of an excellent summary. So thanks for coming back and giving us an update. Obviously, hope that it continues to go well, and hopefully we can get you back, in a year or so's time, and just see how things are going again.
Well,
But
yeah, in a year or so's time, I'll be approaching my 50th year in the city, so that'll be quite interesting.
we'll
done 48 and a half now, so so far so
still
good.
have lots to talk about. Yeah, yeah. I think with sort of Trump this week, it's going to be interesting 4 years. So
yeah, so that wonderful one. May you live in interesting times.
Brilliant, brilliant. Okay, thank you very much. Until
Thank you, Matt.
next time. Right, just ever so quickly, as I say, there are some sort of more disclaimers here. Once again, please sort of read those ideally at your leisure. I think James will be back next week, and he's going to be interviewing Sebastian Leon from Personal Assets. And then we've got Alex Krupp from Bankers on the 22nd. And I know there's some more things in the pipeline sort of coming through after that. But thanks, everybody, once again. Obviously, apologies for the delay at the start, but hope you've all found it very interesting and have a great weekend. Goodbye.